What we think is that this is the right sentiment which is there in the economy policy makers in the country right now. The reason is very simple, that India is the second most populous country after China. With such a large country, an inward-looking approach can definitely help in terms of growth. And there have been a lot of slack in the economy. Globally, there is a lot of slack in the economies. And what we can do, because we cannot control the external economy, but we can control our own economy. And this can definitely help us in growing at a faster pace and not a more opportune moment than the current one, where India is a net importer and India can clearly benefit out of the lower commodity prices. We have seen the commodity prices correcting by a sharp amounts, and this definitely helps us in taking up this opportunity and growing at a brisker pace. I think this is a valid thing, and also inviting foreign capital is a good idea, because with the amount of liquidity sloshing around in the overseas markets, if it can come back to India in some way and help in building up our infrastructure for the longer run, it can help India at this juncture. Secondly, from our own perspective, we are starved of capital. We have seen it in so many instances. Whenever there is a need of capital, from a domestic capital side, the government is stretched, and even now also, despite some consolidation, we cannot splurge around and spend. Otherwise, our macros again will get under a stress. So I think it's a valid sentiment in the policymakers to look at the growth at this juncture, despite the fact that IMF has, in its World Economic Outlook, in the recent October 10th issue, said that India is going to be one of the fastest growing economies. When we estimated the repo rate in April 2015, we had estimated the inflation rate, and we did not expect this kind of rate of disinflation, which actually turned out. And if you look at it, a large contributor has been the global deflation, which basically means the commodity prices, which have actually helped India in controlling inflation in a big way. Also, some policy measures from the government has helped, which were kind of absent in the prior regime, and this has actually helped in controlling the inflationary pressures, and this rate of disinflation has been larger than what we had expected. This has caused the central bank to cut the rates more than what we had anticipated. Going forward, we are not expecting any repo rate move for the next 6 months, but maybe next 12 months, if the rate of disinflation is more than what again the central bank is expecting, and we have to look at these from a number basis. If it is there, because the primary job of the central bank is to have a stable growth environment over a longer period of time, rather than looking at a knee-jerk reaction or a knee-jerk motion. So it's rather than stick slip, it should be smooth continuous growth, maybe lower, but over a sustained period of time. So I think we are not expecting any major repo rate move immediately. We are expecting only after maybe about 6 months or so, looking at what the inflation numbers point to. I'll give Dr. Raghuram Rajan an 8, and we think he has done a good job, particularly because he has not buckled under pressure from the government. Done a good balancing job between the economic, macroeconomic factors and the demand from the market. So this is a good job done by him, and particularly in light of the fact that when he had joined the central bank, India was reeling under a pressure of capital exodus. He built up the forex reserves, which was a focus when he came in, and in fact, what we look at probably the time when he had come, India was in need of the foreign capital. We have seen him focusing on the forex market much more than the prior regimes, and he's operated to the forex markets more than the money markets, if you look at it. And if you look at even the import cover has improved, our forex reserves have improved, our FPI and FDI have improved. So with the set of macroeconomic indicators which are much healthier than what we had earlier anticipated, our current account deficit has come down about 1.2, 1.3 levels, and our fiscal consolidation has been there. So he has pushed the government to follow a path of fiscal consolidation, and that's the job of the central bank. I think he's done it well, and hope he does it even better from here. I hope Dr. Rajan pays a little more attention to the development of the corporate bond market, because this has been an agenda over a long period of time, and obviously it requires a lot of coordination between the ministry and various states. But if RBI decides to push it like what they did on the government bond platform, I think liquidity would improve in the corporate bond market, and this could help in raising monies for other companies at a lower cost, which will be an efficient way of deploying money at productive use. So definitely instances like these mar the confidence of investors, and it raises a doubt. But even in the past and from the current scenario also, I think the industry will learn, and we have seen in the past also the industry has learned from the earlier cycles whenever such instances have happened. And if you look at it from an industry point of view, mutual funds is a conduit of savings. So basically, this industry is a very important industry and an integral industry to channelize the savings of individuals into various asset classes for productive uses, and this is something which industry will keep on doing. I think these instances only raise up flags to be more cautious going forward and deliver value. The only thing which probably the industry has not done enough is probably in making somehow, because I think all mutual funds cannot reach to all the investors simultaneously. The risk of the funds need to be delineated very clearly to the investor, because if you look at it, the model overseas is very clear that if you are guaranteeing the NAV of the fund, because such instances are beyond the control of the investment managers after a certain due diligence process has taken place. So if the investor should be well aware of that there is a chance of credit risk, and if he is not comfortable with such kind of a risk, he should not put money in such kind of funds where credit risk is an integral part. So that is one way of looking at it. Even from duration perspective, some investors are not comfortable with volatility. So they should be aware that if you are going in increased duration product, volatility is bound to happen, and they should be well aware that these what is the kind of risk or what kind of volatility or what kind of horizon they are comfortable with, and what kind of return expectation they are comfortable with. Because there is definitely on the fixed income particularly, there is definitely a way of knowing your returns within a tolerance band. In Sundaram, what we have done in the past is that is now almost about 5.5 years process that we had disjuncted or disjointed credit process from fund management process. And from a hindsight perspective, now we see that this has helped us in addressing credit risk better. what it does is that it removes the conflict of interest which is there in the fund management team, and the credit analyst is able to analyze the security in full perspective, and the merits of this has been as stated here what we have done. From a disadvantageous position, I can say that what has happened is that probably it takes a little more time in terms of evaluating the security, because we do a thorough process before including the name into the credit universe. Second is our accrual yields on the portfolio are lower than probably the competition or the guys, the industry or the fund houses which look to take up more credit in their portfolios. One is obviously the Sundaram brand, the trust of Sundaram brand. It's a strong brand, and this is something which the investor should bear in mind, that a lot of process goes behind this brand. Second is whatever when we onboard an investor in a particular fund, we have delineated or we have classified funds as per the duration buckets. So we can assure the investor that we do not take excessive risk in a particular category. We take risk commensurate to the risk category, and we do not take risk as per the market conditions. We don't depend on the market vagaries. We typically stick to the fund mandate, and if the investor has to take more risk, he needs to move from one fund to the other fund. The third point is that there is a very able team looking after the funds, and they know the market responses, what to do, what not to do in various situations. I think these are the best three points on which Sundaram mutual debt funds can be sold. The fourth point which I would add is, which also resonates with Sundaram mutual brand, is customer orientation.
Mutual fund investments are subject to market risks. Please read the offer document carefully before investing.